ILITs, again, are really for folks that are worried about estate taxes. But maybe let's just start with kind of what are the basics of what is an ILIT and what's their key feature, Peter?
Yeah, so an ILIT, so it stands for Irrevocable Life Insurance Trust. And so the basic idea is it's an irrevocable trust that holds life insurance policies or is designed to hold life insurance policies. The slide mentions that ILITs are generally what's known as intentionally defective grantor trusts. We have a separate webinar about IDGITs, but basically, the short explanation is that it's a type of trust that is considered outside of your estate for gift and estate tax purposes, but is ignored for income tax purposes. And so to the extent that it generates income, you would pay the income tax. Although with an ILIT, typically it's just owning insurance, and so there's
Yeah.
no real income tax liability most of the time.
Yeah, and just another
Um,
kind of simple piece on that.
yeah.
There's really two types of irrevocable trusts that people use for kind of estate planning. Is there's non-grantor trusts and IDGITs, what Peter just mentioned. The non-grantor trusts are outside of their own tax entity for estate tax purposes and when paying income tax. So the trust pays its own income taxes. IDGITs are also outside of your estate, but the grantor or the person who sets it up pays the income tax. That's the key high level difference between them. There's nuances at a deeper level, but as Peter said, we have another webinar that you can watch if you want to go deeper on that. But what's the key feature of, so ILITs are IDGITs, right? But what's their key feature and kind of use case?
Yeah, so the basic idea is if you're someone who personally or has a client who thinks they're going to be over the exemption amount when they die, ILITs can be a really powerful estate tax strategy, and there's a couple of reasons for that. So one is you move the death benefit and any cash value out of your estate by purchasing the insurance policy in a trust rather than in your own name personally. So if you let's say to make things really simple, let's say you had a term policy on your life and you die, the policy's in effect, it pays out $6 million to your family. You're probably going to pay, or your family's probably going to pay $2 to $3 million of estate tax on the death benefit, assuming you don't have an irrevocable life insurance trust. But if you'd put that into an irrevocable life insurance trust, probably the entire amount would have been outside of your estate. And so your family would have gotten the full $6 million instead of $3 or $4 million. So that's the basic idea. And there's a few reasons people
I
like
just want to,
ILITs.
yeah, I just want to like essentially to call this out is, and this is broadly true of whether it's an insurance policy of generally part of these, whether it's IDGITs or non-grantor trusts, you use these irrevoc. If you're worried about the estate tax, you put your assets that you expect to appreciate inside these trusts so that all the appreciation won't base us gift and estate tax. Because if you keep it in your name, all that appreciation will be taxed when you pass away. Versus if you gift it today, only the value today could face that tax, but all the appreciation won't be subject to it. Is that the right way to frame
Yeah, yeah, and depending on the policy, sometimes you don't even have to make a gift. So like a term policy, a $6 million term policy, the premiums might actually not be that significant. And so you might be able, we can talk about this later, but there are ways to fund insurance trusts without having to make taxable gifts to the trust to fund them. In some cases, you can actually transfer the death benefit to your heirs without making even a single taxable gift.
Got it. And this is it's just something that's like this is something that is fairly common of most wealthy families, like really any wealthy family that people have heard of probably do use an ILIT for insurance. Is that fair to say, Peter?
Yeah, they're extremely common. So there's a couple of benefits of them that I haven't gotten into. So one of them is just the basic idea that you're shifting value out of your estate, and so you're getting all the death benefit and any cash value out of your estate, which is very powerful, especially if you have a longer time horizon. The other benefit of an ILIT is it gives you, in insurance in general, is it gives you a source of liquidity. If you think you're going to have to pay estate tax, or your heirs are going to have to pay estate tax when you die. So the classic example is somebody has a large illiquid asset, maybe a small business or something, or just a large piece of real estate. and they want to keep the asset in the family long term, but they know that there's going to be significant estate tax when they die. And so the question becomes, how are my kids going to find the cash to pay the estate tax without selling the business or selling the land or whatever it is? And one strategy is you get life insurance. Life insurance is outside of your estate in a trust. And then when you die, your estate can borrow cash if it needs the cash to pay estate tax. It can borrow the cash from those trusts and pay the trust back later. And so it's a source of liquidity to pay estate tax. And at the same time, it's an efficient way to get value outside of your estate for estate tax purposes.